There was a huge rush to buy I-bonds at the 9.62% rate, but for those who are seeking longer-term inflation protection, some tips may be the better option. Yahoo Finance's Kerry Hannon is here to explain. So, Kerry, why should investors give tips a second chance?
Right. Now, this is just another way to kind of buffer you against inflation, right? These are treasury, inflation protected. They're, securities, they're backed by the government. So, even if they were to go down, you're going to always get your principal back. So they're super safe. But the thing that makes them interesting, apart from the I bonds, which we all grew to love this year, is that you have more opportunities to invest more in these tips. With I bonds, you have a limit of $10,000. With these, you can invest up to $10 million in them if you want to. And so you can have a bigger play here. You can get in at increments of $100. You can buy 5-year maturities, 10 years, 30 years. But you can sell them anytime. With I bonds, you need to hold them for a year. And then you also, you really should hold them for 5 or you lose some interest. These have a lot more liquidity to them. So you can invest more. You have liquidity, and this is the cool thing. You can buy them in retirement accounts, which the I bonds you can't put into retirement. So for retirees, it's not a bad way to sort of park some money where you're protected against inflation, and you're going to get your principal back. So it's that kind of outlook. It's a longer term perspective. And really looking forward to, where do we think inflation is going? But this is one good way you might consider. You can also buy them with I bonds. You have to buy them at Treasury Direct. These you can buy through brokerages. You can buy them in mutual funds. You can buy them as ETFs, index funds. So there's different ways you can get a little protection from inflation through this type of investment.
And Kerry, what about drawbacks? What do people need to know?
Yeah, it's a really good question, because if you don't hold them to maturity, because of the way these work, so the interest is applied, and so your principal goes up based on the interest. So if you cash them out sooner than maturity, there's a possibility that you could have a negative yield. Now, right now, as I think I mentioned at the top, these are yielding more than the I bond. So it's right now they're actually at a good yield, but since they fluctuate over time, it's possible that if you don't hold them to maturity, you could have a negative yield. Also, unlike I bonds, if you buy them in a mutual fund or in a bond index fund, you have a chance of also having them decrease in value in a way because they're part of a bigger system here. The final thing is that taxes. You're going to pay federal income tax on this as you do with I bonds, but it's a little tricky. So it's worth talking to someone about how that works, because there can be a little bit, especially if you hold them in your retirement accounts, that's all cool. But if you hold them in a taxable account, you're going to be expected to pay some tax, federal tax, not local or state, but it's worth talking to your tax professional about.
All right, so do your homework on that one, but always good to have some options. Kerry Hannon, thanks for joining us.